Good afternoon, everyone. Welcome to this update for global stocks and commodities for the 3rd of June. The bull market in global stocks has really progressed another notch, and in particular in the US is looking very positive after the week we've just had. So I think it's safe to say that we've probably come out of the shaky bit, which started in February. 4 months of consolidation after the very good run we had in 2017, and then of course led into a very strong January, is about right. That's somewhere between 3 and 6 months is typical consolidations that you see. So let's jump in and have a look. I did say last week that there was a lot of boxes being ticked. A lot of boxes had green ticks last week, and that certainly did prevail in the week that we've just had. And it was a very positive finish on Friday night, based both on fundamentals, because there was a very good jobs report, and also on the technicals, as you will see when we get into the charts. There'll be the normal stock and commodity trend update, and portfolio analyst last week, I went through NYSE listed China stocks, put forward the 5 or 6, 7 of my favourite stocks and the ones that are performing the best. And I think in the week that we've just had, that all played out pretty well. They all continued to advance. I also covered cloud computing as a theme as well, and there's some terrific opportunities in that space. Now, I may have mentioned a couple of weeks ago that I've been working on a new training course. This is just the best information that I can put together. It's concise, it's very practical, and it's now available for members. So we've rolled that out, and it'll roll out sequentially over a few months. It takes a lot of time to put it together, and I'm just going to roll it out sequentially. The first 5 modules are out and available, but there's a lot more to come. The scope of the training course, just the really important things that you've got to understand about what actually drives the prices in the market and how you can determine that yourself. And I'm going to give you an example just to show you the sort of technical analysis that I do and what insight you can get into future prices. And there's obviously trading psychology is important. You know, how to really set yourself up effectively to engage with the market. The fundamental analysis template that I use, which I think works very well. Technical analysis, of course, in depth, as you'll see, and setting a trading plan, and several other things as well. So that's a training course that I'm very pleased with the way that it's come together. Now, American stocks, the S&P was up by 2.2% for the week, but overall for May, despite the fact that it was somewhat volatile, we still ended up with a 2% gain for May. It doesn't actually feel like it. It felt a lot more negative, with a lot of the negative swings and the sudden knee-jerk reactions that the market had to the trade discussions with China, to the political elections in Italy, to whatever came up. But look, Friday night there was a very positive jobs report, and Italy would appear to have resolved its political issues, and so the fright that was taken early in the week over that seems to be fading. The index itself is in the middle of the range, but it's looking quite bullish. I think the next stop is resistance at 2800. I think there's little doubt that the path of least resistance is to the upside. I want to take a look at the Russell 2000, and I also want to look at the technology index. So we'll look at XLK as well. There are lots of breakouts and some powerful uptrends to be found in the strongest industry groups, and I've talked about that previously. Now the US dollar ended up flat for the week, but the 10-year bond slipped further down to 2.9. So it's interesting that the US dollar was able to to hang on to those previous gains. All right, let's jump in and take a look at, first of all, I just want to take you through, this is an Australian stock, and this is not a recommendation at all by any stretch of the imagination. This is just an example to show you the sort of information that you can glean from price charts. So this is a stock called Fisher & Paykel Healthcare, and if we pan back, you can see that it was in an enormous uptrend. Went from around $2 in the middle of 2013, and it got to $10 by the middle of 2016. So 2 to 10 over 3 years, very strong gains. We then got well ahead of the moving averages, as you can see, and so that begged the question, would we get a more substantial pullback, or would we in fact even go into a bear market, which is a 20% correction or more, if the if this was going to roll over. And at this point in time, there's some information that you can get from this price chart that gives you some insight whether this is going to be a consolidation in an ongoing uptrend, or whether this in fact is going to be the start of something more major. So just some comments to make. Once we'd formed this little buying climax here in June of 2016, the market didn't really want to fall too sharply. In fact, you could see that there's hardly any volume behind this little consolidation. Now, eventually, the market did break these lows. So we did get a break of these lows, and we got into a bit more of a significant correction. And there's some structure around here that will help you a lot going. Sorry, just get rid of that one. So there's a lot that you can determine at this stage that gives you a guide. So when we get our first run down to support, that's worthy of putting in a support level. And then we want to see where the market bounces to, so that's worthy of putting in a resistance level. And it's remarkable how, to what degree, the price then respects those support and resistance levels. And you've got to allow a little bit of overrun. So here we got some significant selling, and you can see some higher red volume candles indicating that there was still active selling, as you would expect in the early stages of a consolidation. But then you'll notice that we very, very quickly, so that's the first tip off, we very quickly settled down again. This volume, what you're looking for is for the volume of selling to dry up, because until the volume of selling dries up, the price really can't go up. So the volume of selling died away very, very quickly, and it was replaced by some increases in volume, but on the up. So you'll notice this little rally up here, back up to resistance on rising volume. Good sign. We got a little pullback on low volume, and you'll notice that all of the bigger volume candles through here are all to the upside. So quite clearly, as we came through here, we've got a very positive candle. It's pretty clear that this was going to be quite a brief correction or consolidation, and that very likely the next move would be to the upside. So let's just move forward a little bit. So we spent a little bit of time around that support resistance level, which is pretty normal, and then we started to move higher. And the market continued to run up significantly until, again, we formed another pattern that was just like what we had back here in 2016. So we've now advanced to the end of last year. So let's just tighten in on there. So again, we've just put some structure, we'll do it this way, we put some structure around the initial decline, the bounce, and then let's see where that all went. So you can see we came down to support, the volume dried up, the volume of selling, in fact there really was very little selling pressure at all. You can see all through here on this leg down, not much in the way of selling. Similarly here, not much increase in volume, and the same through here. Maybe just at one volume spike there, and that's really about all. And then we got this period of very low volume, and eventually the market has started going up again. So there's an awful lot of information that you can gather many months in advance. All right, let's move on. Let's look at the S&P first of all on a daily chart. So you can see we're in this wedge pattern up until early May. We broke out of that wedge pattern, formed new highs, new short-term highs. We've spent a bit of time around that area, so the best part of 3 weeks, and then very positive on Friday. And it looks very much like the next move will be up to challenge this resistance at 2,800. So that's the S&P. Let's look at the NASDAQ. Slightly more advanced than the S&P, but the same process. And you can see that whilst the volatility, the fluctuations up and down, are much greater than we saw through 2017, the rate of increase is still pretty much the same. It hasn't really changed from where we were in 2017. It's virtually identical. We've just got bigger swings on either side of that average line. So the NASDAQ looks to be heading higher, and of course the real story is the Russell 2000 for small caps has broken out, is at new all-time highs, and we got a rally up, we got a retest, perfect retest, and then off again. So when small caps are leading like this, it's a pretty positive atmosphere around the market. Let's look at DXY. So the US dollar almost got to resistance at 95.2, pulled back a little bit and then steadied. So we might have another go at it yet. So I think the chances are the US dollar is going to have another go at moving up a little more strongly. Now let's just look at XLK, which is the technology index as well. So the technology index down this bottom window is the technology index relative to relative strength compared to the S&P 500, and you can see that it's just continued to outperform the S&P for a long period of time. This goes back to October 2016, so that's more than 18 months ago. It was a very steady trend, got more volatile here in February and again in March, but we're almost back to all-time highs. Just tighten in on there. So XLK looking extremely positive. Now, the Aussie stocks, our dollar didn't do much. It was up and down a little bit, but ended up where it started at 75.7, and so we've got a consolidation zone going on in the Australian dollar after quite a sharp drop down from 81 cents. The ASX 200 was up 43. Sorry, it was down 43 points for the week, so it's back down under 6,000 again. That was a 0.8% drop for the week. Energy and banks were the main drag, and CBA has now broken down. And we'll look at that chart as well, because that's going to make life very difficult for the overall index. So if we look at the ASX 200, so we're just back down under the 6,000 level, 5,990, but we've certainly backed off quite sharply from this 6150 peak. And if we look at the finance sector in Australia, this was key support here at 61.85. We then fluctuated up and down. It really wasn't definitive that it's broken down, because this is only fairly mild here. It's quite possible that this could have come down to this level, formed a little double bottom, and then basically gone back up into this range up in here. But we are now clearly have broken down over the last 2 or 3 days, and you've got to say that there's every chance and every likelihood that the banking sector is going to be heading back down into the mid 5,000 point mark. So we could be looking at, this would take it down about another 7 or 8%. Now let's zero in on CBA because it's clearly the weakest. This is CBA on a weekly chart. We've just got a relatively small break, although it has been going now for 2 or 3 weeks because these are weekly candles, not daily candles. Now, look, the people that are in love with the banks, and there's probably a few million of them, and with good cause over the last few years, the banks have been a good investment. But as I've been saying now for probably over a year, they're really facing some headwinds. But the people that are in love with the banks aren't going to let them go easily. So I'm expecting that we will get perhaps a rally back to test this breakdown. But it looks pretty clear now that the CBA and the rest of the banking sector, that the odds are that they're going to head lower, and that could be, of the order of 10%, which would, if you're holding bank stocks for dividend, you could see the next 2 years' dividend wiped out, and that's even if the banks can sustain their dividend. There's just been so much negative come out of the Royal Commission, so much damage done to the brand that it's really hard to know how this is going to play out. Okay, while I'm here, let's look at gold. So this is gold on a daily chart. Hasn't really done much now for a couple of weeks. We get a better fix looking at it on the weekly chart. So no real change. We're still in an upsloping channel, and we've still really got to get above 1380 for anyone to get excited about gold stocks. There's GDX, and as you can see, this is a weekly chart as well. There is just absolutely nothing going on in the gold stock major space. This goes all the way back to November of 2016, so we're more than 18 months now of virtually no movement in the global gold stocks. Gold, in fact, was slightly lower. That should read by $7, and I think the resolution of the politics in Italy probably put the brakes on any sort of increase in the gold price, and of course you've got the US dollar strength is working against it as well. So still no net movement, which is pretty boring in the precious metals space. Other commodities, copper was steady, wasn't down, it was steady, and crude oil, however, was down again sharply. So we broke above 70. And now have pulled back quite sharply with rumours about what OPEC are doing with with releasing the brakes on oil production. So the whole energy complex had got ahead of itself, which is why I haven't been interested in taking a position in the last couple of weeks. And we got a sharp pullback in prices, but I did note it steadied on Friday. Even though the crude oil price was down by probably about 3 or 4%, the energy and exploration stocks actually did steady on Friday, so that might be a bit of a positive. There's the spot copper chart. There's our crude oil. You can see we managed to get up just above 72, and then we've had quite a sharp pullback there. So let's just look at XLE, which is the overall energy complex, and you can see we've run up to a triple top in XLE, then pull back very sharply, and in fact that pullback, I think it started pulling back before the oil price, so the oil stocks were anticipating that move in oil. We got quite a sharp pullback from around 70 78 back into the 73s, but as you can see, it did steady quite nicely on Thursday and Friday. So to wrap it all up, just as I've just been reiterating now for a long time, you've really just, the divergence in the market between the stocks that are performing and the stocks that aren't is really quite significant. So stay focused on the strength. Stronger stocks in the stronger sectors. It's it's a pretty straightforward approach. If you're organised, technology is strong. there's very selected healthcare stocks are strong, particularly in things like instrumentation, certainly more than biotechnology. And also some selected industrials are doing very well also. Now, portfolio analyst this week, I'm just going to have a look at what happened with the China listed stocks that I covered last week, because it's been quite a nice advance. And I'm also going to look at a few of the technical industry groups as well. And of course, I'm also going to have a local opportunity or two as well. So if you haven't had a trial of Portfolio Analyst, there's a free 2-week trial available. I'd encourage you to have a look at that, and I think you'll get quite a bit out of it. There's my contact details for any non-members, and I'll look forward to being back with you again next weekend. Cheers.